Hello and welcome to Simplicity in Stocks. In the stock market, those who don't understand the fundamentals of the companies they are buying will probably end up losing their money. So it should be no surprise to hear the old stock market saying that more than 90% of traders lose money in the long term. But there is a simple way to beat the odds and beat the market too. To do that, you need to become a long term investor. So, if you are ready to take the plunge as a long term investor, the first question on your mind should be what kind of stocks make good long term investments? Stocks represent ownership of businesses. Thus, the best stocks for the long term will be those companies that do the best over the long term. In this video, we will look at four fundamentally strong stocks for your 2026 watch list. These are stocks, if purchased at reasonable valuations, can be held for the long term. But first, please note that this video is for information purposes only. It's not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. Tata Consultancy Services. TCS is the crown jewel of the Tata Group. It's one of the world's largest IT services companies. It is known for its scale, execution, and client trust. It's a preferred partner for enterprises modernizing with cloud and AI. In FY25, TCS's revenue grew 6% to Rs 2.55 trillion with EBIT margin of 24.3%. In the first quarter of FY26, revenue was up 1.3% year on year but down 3.3% sequentially in constant currency. The company was hit by the BSNL contract ramp down. The margins were 24.5%, little softer than expected due to excess capacity and higher variable pay, though cost controls and forex movements offered some support. The management believes that AI will expand IT budgets, creating a net revenue positive effect. The BFSI and tech segments are resilient for the company, while retail, auto, and healthcare are soft. Moreover, the management has stated that margins can only move back up to the 26 to 28% band once growth climbs back to high single digits. Indian IT companies have invested considerable time and money to get the entire workforce AI ready so as to be prepared for this disruption. TCS has led the charge on this front. The company's future revenue growth will depend a lot on how it fulfills the demand of AI-related services in the face of intense competition. HDFC Bank. HDFC Bank, with about 10% market share in the Indian banking sector, is one of the most respected banks in the country. The company has merged with HDFC Limited, creating an entity with global potential. It's India's largest private sector bank by assets, the second largest bank in India, and the market leader in almost every asset category. The bank relies on a model of wide franchise and low-cost deposit base. This ensures good pricing power and sustainability of above-average net interest margins (NIMs). As a result of this strategy, it has always reported consistently good earnings. This has, in turn, led to high return ratios compared to its peers. The management of the bank is conservative with its margins and provisioning policies. So it should come as no surprise that HDFC Bank's net NPAs have never crossed 0.5% of its loans. The bank is also a leader in digital initiatives, taking continuous measures to enhance customer relations and add value to its customers. For FY25, the bank's net NPA stood at 0.4% of total advances. Its gross non-performing asset ratio also improved and stood at 1.33% against 1.4% in December 2024. Its net interest income and net profit have grown at a healthy CAGR of 12.1% and 16.2% respectively in the last 5 years, and the net interest margin, that is NIM, has averaged at 3.8%. For FY26, the management expects to grow at a market rate with a focus on gaining market share in deposits and advances. While the short term looks stable for the bank, the long term picture looks positive. HDFC Bank has been investing in various startups to fill gaps in its portfolio and gain expertise in niche services. This will help the bank stay ahead of the curve in the fintech race. Hindustan Unilever Limited. HUL is a subsidiary of Unilever, one of the world's leading suppliers of food, home care, personal care, and refreshment products. The company has 50 plus brands under one roof, spanning 15 categories like food, beverages, cleaning agents, personal care products, water purifiers, and other fast moving consumer goods. The company's products are present in 9 out of 10 Indian households. Forbes has rated HUL as one of the most innovative companies in India and 8th globally. It's a zero debt company with rock solid long term fundamentals. In FY25, revenue was at 607 billion, up 2%. It was almost entirely volume led. Pricing barely moved. The company chose affordability over short term margins. The operating profit or EBITDA was down for the year at 23.5%. The pressure on operating profit came from commodity inflation in palm oil, tea, and coffee that wasn't fully priced through, and from deliberate price cuts to defend market share. Net profit was up 5%, helped by interest income, a prior period tax adjustment, and a one off gain from the Pureit sale. In the long term, the company is well placed to dominate the FMCG market in India despite rising competition. A combination of strong brands, good cost control, and high quality management will ensure long term success. HUL is focusing on brand superiority, category creation, social first marketing, channels of the future, and the winning in many India's framework being followed by the management. L&T is an Indian company founded by two Danish refugees, Henning Loic Larsen and Soren Christian Turbo. If you talk about engineering and infra stocks in India, L&T is the first name which comes to mind. The company has a diverse presence in engineering, construction, manufacturing, technology, and services. It's one of the top 5 construction companies in India. It's also engaged in defense manufacturing, IT, green energy, and financial services. The company has a strong global footprint too, with manufacturing facilities in 8 countries and offices across more than 30 countries. L&T's financial statements make for pleasant reading. Sales and profits have seen a steady increase. The company has recovered quickly from the pandemic and is now setting growth records. Its fundamentals are strong. It has a moderate debt to equity ratio and a steadily growing return on equity. Its cash flows are strong. In FY25, the company clocked a record order inflow of 3.6 trillion rupees, up 18% year on year. Its total order book grew 22% to 5.8 trillion rupees, with nearly half of the orders coming from international markets. Big orders and many structural tailwinds have ensured L&T's long-term prospects are very good. With a 19 trillion rupees pipeline in sight for FY26, L&T is well positioned for continued growth. The company is a powerhouse in India's industrial and infrastructure landscape. It's now transitioning to become a more technology-driven, service-oriented conglomerate with a strong commitment to sustainability and global expansion. We have often heard stories on how investing in the stock market has delivered high returns. Investors are fascinated by the multi-bagger returns that fundamentally strong stocks keep on delivering. But the most important aspect of investing is often ignored, that is the time horizon. History is proof that some of the largest gains have come from investing in long-term stocks. The key to finding the best long-term stocks is to look at all the aspects of the company in question. You need to look at the growth opportunities for both revenues and profits, the quality of the management, the financial performance, track record of dividends, and much more. Consider all these points holistically. The best stocks for the long term are the ones that have a tick mark against all of them. This list of 4 stocks for your 2026 watch list have the potential to deliver the kind of returns that is expected by long-term investors. Investors should evaluate the company's fundamentals, corporate governance, and the valuations of the stocks as key factors when conducting due diligence before making any investment decisions. Happy investing.